Hello, and welcome to the Commonwealth October Market Update. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. It was a tough month. September was better than August, but that's actually not saying much, because U.S. markets were down between 1% and 3%. International markets were down between 3% and 5%, and that's just for the month. If we look at the quarter as a whole, U.S. markets were down about 7%, which is the worst performance we've seen since 2011. And international markets were down by 10% for the developed markets and 18% for the emerging markets. What the heck is going on? Two things. The first is growth is indeed slowing. And the central driver of that is China, which is attempting to make a very difficult transition from export-led growth to consumer growth. And it's happening, but it does mean that growth is going to be slower going forward. So we've got slower growth from China. And the problem is many other countries, most of the emerging markets, have built their economies around supplying endless Chinese growth. So when China slows, they do too. So slowing growth around the world has led investors to say, hey, we're not willing to pay up as much. The other thing is a growing lack of confidence. A lot of the prices that have been paid over the past couple of years have been due to a belief, a general belief that in fact governments and central banks in particular had things under control. Past couple of months, that hasn't seemed to be the case. We saw China mishandle its own stock market crash and then announce a surprise revaluation of its currency. We saw the Federal Reserve hint and dance around raising rates and then step back and say, no, we don't dare just yet, leading investors to say, what did they know that we don't? And here in the U.S., we've just recently averted a government shutdown, and there's a very real possibility we might see something similar in a couple of months. So the confidence in policy is simply not there. And that's also induced investors to pull back and say, you know what, we're not going to pay quite as much as we were. But you know what? As worrying as all that is, it's actually a very good time, at least here in the U.S., for that to happen, because the fundamentals are very solid. We're seeing job growth continue at rates we haven't seen since the mid-2000s. We're creating lots of jobs. We've got a record high level of job openings. We've got a record low level of layoffs adjusted for population. We've seen wage growth start to pick up again. That's been the real missing piece, and it's starting to happen. So with people making more, with income rising, they're spending more. That means they have confidence in the economy. We just saw confidence, the most recent release, tick back up to the highest level since the crisis. We've seen a 10-year high in car sales. We've seen multiple increases in housing sales, both new and existing. If you look at all of these pieces, they say that people are feeling confident, people are starting to spend, people are going to grow the economy. This is what we've needed. This is normality. We're getting there. So if we have to have a drawdown in confidence, now is exactly the time. What does this mean for us as investors? Does it mean there's going to be no more pullback? No, absolutely not. We might see more pull down. We might see more volatility. We probably will. But the reality is that's normal and it's healthy. And in the short term, it can be scary. I certainly haven't enjoyed the past 2 months. But in the long term, as long as the fundamentals remain solid, and they are, we'll be just fine. I'm sure we'll have a lot more to talk about next month, and thank you for watching.